Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform 2.0 to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can follow me on Twitter at @ExporterTax. On this week's episode of Cross-Border Tax Talks, I'm excited to be joined by Chip Harter. Chip is an international tax policy advisor for PwC, and from 2017 to 2020 served as the Deputy Assistant Secretary of International Tax Affairs at the U.S. Department of the Treasury, leading the way for Treasury's implementation of the TCJA. Chip, congratulations on your new role with PwC, and welcome to the Cross-Border Tax Talks podcast.
Well, thank you very much, Doug. It's great to be back with PwC.
Well, Chip, this has been a long time coming, getting you on the podcast, and I have a lot of questions, and we're going to try to keep this to our normal format, but I think this could end up potentially as a 3 or 4 hour one, but I will already advise our listeners that won't be the case, I promise. But I do hope this is the first of a number of conversations that we can have here on the Cross-Border Tax Talks podcast.
Sounds like a plan.
All right. So before we get going on GILTI and minimum tax, which is really going to be the focus of today's podcast, you were involved with the issuance of literally thousands of pages of proposed temporary and final regulations that we have talked about ad nauseum here on the podcast. Before we get going into the specifics, how high up do these types of decisions, some of the key policy and technical decisions that you made, how high up do these types of decisions go? And really, how involved was Treasury Secretary Mnuchin in the process?
Well, it's quite a process, getting these regs drafted. They're put together by drafting teams made up of staff lawyers from the IRS and International Tax Counsel's office. The process is supervised by the International Tax Council, and Doug Palms did an amazing job. I was basically the highest person in the pecking order with respect to international taxation, and so I would review them all very carefully, and was involved in all the meetings to make the policy decisions around what would go in them. Then above me, Dave Cotter, the Assistant Secretary, and then Secretary Mnuchin would be involved. Secretary Mnuchin, his reputation for being a detailed, oriented boss is well deserved. Through a lot of the tax implementation process, we were briefing him twice a week around just where we were in the regs and reporting on our progress. So he got very involved, particularly with respect to the regulations that were getting a fair amount of political attention, including the ones around GILTI implementation and the allocation of expenses to the GILTI basket. I mean, before he was done, he understood, the arithmetic and the mechanics of allocating domestic expenses to the different foreign tax credit limitation baskets, and why everyone cared so much.
I just find that absolutely fascinating, Chip, that the Treasury Secretary understands interest expense apportionment to GILTI, or at least the collateral implications of that. And I just find that very fascinating. So let's go back to that fateful time in late 2017. And I want to really talk about GILTI and spending some time about minimum taxes. Really like to understand kind of how we got to where we are, and then want to get your perspective on a couple of the legislative proposals that we've seen from the administration and Senate Finance, and then also get some of the context and your thoughts with respect to BEPS 2.0 and what we're expecting from the OECD later this summer in 2021. So, but let's start at the very beginning. When GILTI, I remember when we first saw the acronym, kind of scratching our head, and didn't really seem like that global or that intangible or that low tax. It was quite an acronym, but maybe if you can take us back to those fateful days of kind of just the formation of GILTI, and how did that process work, and then ultimately want to get to the, is this really a minimum tax? But maybe just if you could set the table for, when you had just really kind of shown up at or were relatively new at Treasury when the legislative process really began.
Well, it did all move pretty quickly. Again, they were having to pass the TCJA through reconciliation procedures, and so it all got condensed into something like an 8-week process. So it went by pretty fast. And during that process, there was a lot of ambiguity about just how GILTI would work. Was the GILTI going to be just another foreign tax credit limitation basket with a haircut and no carry forward? I mean, specifically, are expenses of the U.S. group allocable against the GILTI basket, with the result that the benefit of those allocable deductions can be lost to a taxpayer with excess credits in the GILTI basket? Or was GILTI meant to be a true minimum tax regime, such that there would be no marginal tax, no marginal U.S. tax on a enterprise if it paid at least a 13.125% average foreign tax rate, and leaving the business on essentially a territorial basis? When we first read the statutory language in the Senate bill over at Treasury, we basically submitted comments saying we're quite confused. You keep describing this as a minimum tax, as a backstop of a territorial system, but just looking at how you drafted it, it looks like just another foreign tax credit limitation basket. With certain further limitations like no carry forward and the 20% haircut. And so we commented on this to the Finance Committee staff. We actually sent them over, draft language saying, if you want a true minimum tax, put in this special foreign tax credit limitation for GILTI that would basically equal the gross GILTI inclusion times the tax rate. But none of this ended up getting clarified during the legislative process. As you probably recall, the committee reports seemed to finesse the issue. There was lots of general language about how Congress didn't expect that a multinational paying at least a 13.125% average tax rate abroad would be subject to residual taxation under the GILTI. But, nothing was definitive in the committee reports. The revenue estimates, were coming out of a black box, but, it appeared that the models they were using allocated expenses against the GILTI, though it wasn't clear that that was based on a conscious decision to us sitting over in Treasury. And, eventually the Blue Book did come out saying that expenses are allocated against the GILTI basket, but that was, long after we had to go through some decision making at Treasury. So, when the ball was passed to us, we had some tough decisions to make.
I remember Chip kind of going through, parsing through that language, and we did a little. I remember just doing we did a little model just I think I naively remember, based on the legislative language, thought that it was a minimum tax. There was that one line, right, in the and I can't remember, the Senate report.
Yeah.
And kind of naively thought that. And then obviously, after kind of walking through even the most basic example, it's just like, well, wait a minute, you could have a company that's paying a blended rate overseas at 30%. And, with expense apportionment, specifically interest expense apportionment, holy cow, this company could still pay a significant amount of US tax. And I remember that light bulb going on. And I know that there were lots of comments from corporations, and there was even a couple articles like in the Wall Street Journal highlighting specific taxpayers and some of their issues. So how did you guys react to that once you kind of accepted that, all right, like expense apportionment is going to happen, GILTI is not really going to be, it's not a minimum tax because of the way the foreign tax credit limitation in the basket works, that in other words, companies that pay a blended rate at or above 13.125 could still pay US tax on their GILTI because of expense apportionment. So Chip, once we concluded that this wasn't a minimum tax and expenses were going to have to be apportioned, how did you react to that? And what were some of the key policy decisions and things that you considered to try to minimize some of the blowback or adverse consequences as a result of our foreign tax credit limitation structure?
Well, yeah, given all the confusion in the legislative process, the first decision we had to make was whether there was any basis for us implementing regulations that called off allocation of expenses to the GILTI basket. And I mean, we stared pretty hard at the statutory language, but ultimately concluded that, in Section 904, the GILTI basket was just one more basket. And there didn't seem to be anything sufficiently unique about its statutory drafting to justify a completely different treatment of the GILTI basket from all other baskets for expense apportionment purposes. So, as much as people wanted us to, we simply concluded that was not consistent with the statutory language, regardless of suggestions to the contrary in the committee reports. So that's where we landed fairly quickly. When news got out that we were writing regulations requiring expense apportionment, it got quite a political reaction. The Secretary Mnuchin got a fair number of personal calls from prominent Republican senators who carefully explained to him that that was not their intent, that they meant the GILTI to be a true minimum tax, and that we should implement it accordingly. But after a lot of study and back and forth, we ended up requiring, as a general matter, that expenses be allocable to the GILTI basket. But we did conclude that under our regulatory authority with respect to expense apportionment, we could write some special rules that reflected the differences between the GILTI basket and other foreign tax credit baskets.
Yeah, R&E, I think, being one of the obvious choices in that one. We've dedicated some time on the podcast to that particular issue. So what are the other things that
the fundamental one was, given that, there's a 50% deduction against your GILTI inclusions, effectively, that tends to throw a lot more people into excess limitation position than in other baskets, because effectively the rate is half what the normal statutory rate is. And therefore, we thought it appropriate to treat the stock producing GILTI inclusions as effectively 50% a tax-exempt asset, and therefore reduced the allocations against the GILTI basket by half of what they would otherwise be. And so, that was the first and the biggest accommodation we made to the special nature of the GILTI basket. And then, as you were leading to, more recently, we issued final regulations that provide that no R&D expenses are allocable to the GILTI basket, because if a CFC is utilizing technology developed by its U.S. parent, 367D provides a mechanism where that the U.S. parent should be fully compensated for the use of that technology through royalties or deemed royalties, and therefore, and those are general basket items, and therefore none of the residual profits net of those royalties or deemed royalties that are being taxed under GILTI should be attracting the expense allocation. And so we thought there was a solid theoretical basis for that rule as well.
Yeah, I will acknowledge that I already have taken for granted the 50% kind of exclusion, if you will, on the GILTI. But you're right with the architecture of the Section 250 deduction. That did take an extra step, which is,
and that was a fairly big deal, given
fair enough.
The effect on the revenue estimates of doing that, and it was there was a fair amount of internal debate, since we at Treasury are responsible for revenue as well as consistent implementation of the legislation.
Sure. So I think that's a perfect segue to the other area of relief related for companies, particularly that operate in high tax jurisdictions, which is the high tax exception. And that has gotten a lot of publicity, both when it was originally introduced and then, reproposed and finalized. Can you talk a little bit about that? And then it's recently obviously gotten some more publicity in the Senate finance proposal. But tell us a little bit, maybe just spend a couple minutes on the high tax exception and kind of that process, and to really narrow. And I will also acknowledge we've spent quite a bit of time on the cross-border tax talks. And I think that the consensus, at least amongst the practitioners that I've spoken with and a number of the taxpayers, is that is a very narrow exception that was drafted by Treasury, which we can understand just from the revenue point that you had made. But talk a little bit about that process.
Yeah, it seemed pretty counterintuitive that, for instance, GILTI income, income from, manufacturing automobiles in relatively high tax jurisdictions could actually get worse treatment than, subpart F income and passive income, given that, there are foreign tax credit carry forwards for, general basket income or even passive, general basket income. And GILTI, was, at least by title, meant to relate to low taxed income. And there was a dichotomy between the treatment of GILTI and subpart F income. And, we were aware that people, therefore had an incentive in many cases to transmute, what would otherwise be GILTI income into, subpart F income, to get the better foreign tax credit limitation treatment, and all of which seemed to us to be, counterintuitive and not part of a well-integrated set of international tax rules. So we were, trying to figure out, whether we, had some basis for allowing taxpayers to get essentially true territorial treatment for income earned in high tax subsidiaries.
Very fascinating. The Secretary of Treasury penned a letter to the Wall Street Journal calling for a global minimum tax. And you had mentioned this. What do you think are the realistic prospects? Because one of the other jobs besides issuing all of these regulations was your involvement with the OECD process. And what do you think the prospects are for really like a true global minimum tax in the context of Pillar 2? And I appreciate that, what the OECD comes to an agreement and what we ultimately see in paper could also look a lot different from what countries actually implement. What are your thoughts on that?
Well, at the OECD, we've been negotiating for 3 years, basically, and, the French and Germans decided they liked the concept of the GILTI. They wanted, to put it on the OECD agenda along with the Pillar 1 stuff about reallocating more to market jurisdictions. As they did so, they, for the reasons we've discussed, wanted it to be a country-by-country regime. And we got, fairly close to reaching, agreement on Pillar 2 last year. A lot of strong technical work was done around it. I think, most of the conceptual decisions have been agreed upon. The remaining stumbling blocks were, one was, the treatment of the U.S. GILTI, whether it would be a qualified income inclusion regime. And there was some questioning, particularly from the UK, which doesn't much like Pillar 2 to begin with. They were questioning whether US multinationals would be systematically advantaged if they could, live with a GILTI regime which operated on a global blending basis, while the rest of the world would be subject to a country-by-country Pillar 2 regime. And we debated that a lot. The OECD Secretariat did a quantitative study where they concluded that sort of overall and in general, US-based multinationals would not be advantaged vis-a-vis other multinationals if US multinationals got to stay on the GILTI. And we pretty well had that, on the road to being resolved. Notwithstanding all that, the other issue that prevented us from agreeing on GILTI last year was that a few countries, most prominently the UK, took the position that they just were not willing to agree to Pillar 2, which they are less than enthusiastic about, unless there's a simultaneous agreement with respect to Pillar 1, which, they have a much bigger appetite for. So, we were getting, reasonably close last year. I do think there is a good chance that it will be, pushed over the finish line in this year. And I'd also observe, as you were indicating earlier, that Pillar 2 could have a big effect on the world, even if a limited number of the larger holding company jurisdictions end up adopting it. It's not a provision that you need 139 countries around the world to all agree to implement, as long as the major, headquarters jurisdictions implement it. that will provide some incentive for low tax countries to raise their corporate income tax rates. And again, the operation of the undertax payment rule would both incentivize countries to get on board with it and collect the tax themselves, and could help make it effective, even if not all companies are subject to Pillar 2.
Yeah, I think one of the big challenges for that is Ireland, right? And they've already made some public comments in response to the U.S. administration's proposal to the or report to the OECD, and so Janet Yellen's comments, and so that seems to be a big challenge with Ireland at a 12.5% rate, and then at being a part of the EU, and then for my understanding is with respect to the EU, like for the anti-tax avoidance directives, for the first two anti-tax avoidance directives, anything that implicates tax, generally speaking, needs to require unanimous consent. And so, it would seem that if Ireland was going to agree to minimum tax, it's going to be at 12.5, which then you kind of question, does that still really accomplish the policy goals that the U.S. Really is trying to set forth with this minimum tax?
Well, as you suggest, the Biden administration has a strong incentive to try to negotiate the minimum rate for Pillar 2 above 12.5%. For the reasons you discuss, I do think it will be difficult to get uniform agreement on a rate above 12.5%. But I do think it may end up being a minimum standard, and other countries, including the U.S., are free to have higher minimum rates.
Well, Chip, I think that is a perfect place to end things. And as those developments occur, of course, you'll hear more about it here on the Cross-Border Tax Talks. Chip, I just want to thank you very much. It was an honor to have you on the podcast. I still have so many more questions. I'm sure our listeners do. Hopefully we can get you back to explore some of the other issues. But this was something that I've been hoping for several years to be able to ask, and you've shed a lot of light onto the process that happened at Treasury, and really appreciate you joining the Cross-Border Tax Talks today.
Good. Well, thank you, Doug. It's great fun. Let's do it again.
All right. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you again to Chip Harter, an international tax policy advisor for PwC. I'm Doug McHoney, PwC's international tax services leader. Stay tuned in 2 weeks for another exciting edition of Cross-Border Tax Talks.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.